Hello, and welcome to this ERI Scientific Beta webinar with Dr. Felix Goltz, Research Director with Scientific Beta. Today's topic is entitled Smart Beta is Not Monkey Business. We're going to go through monkey portfolio arguments and discuss whether such random strategies can deliver real outperformance. At the end of this webinar, we will also be taking live questions from our viewers. So if you have a question for Felix, please send it to us via your webinar interface. We are also conducting a survey on the interface, so please respond and we'll share the results shortly. The survey questions are, the first one being, do you consider the following factors to carry a positive long-term premium? And you have a multiple choice option between the size, value, momentum, low risk, profitability, and other factors. The second question in the survey is, do you consider that smart beta providers offer easy access to the following information? Detailed performance attribution of their strategies, detailed risk analysis of their strategies, and full transparency on historical holdings data of their strategies. Okay, Felix, so let's begin. So we hear a lot about monkey portfolios. So can you tell us exactly what they are and what they have to do with smart beta?
Yes, so the idea behind monkey portfolios is that you can construct completely random portfolios, so the weights are actually attributed to stocks in a completely random manner.
Okay.
And so the idea is that these randomly designed portfolios, they actually outperform cap-weighted indices. So this is, if you will, the first part of this monkey portfolio argument. So that seems surprising at first sight. I mean, how can something that is completely without any strategy and just designed randomly, how can that actually outperform cap-weighted indices?
Mm-hmm.
But this part of the argument is actually quite straightforward. So this is called a monkey portfolio. The idea is basically, you take a list of stocks, say you have 100 stocks, and then you could just randomly attribute weights to each stock. So say you could put a $1 bill on each stock, and you could take a monkey who does that randomly. You give him 1,000 such bills, and if he gives just randomly kind of $1 on each stock, and he does that repeatedly, you would come up with a so-called monkey portfolio. And so the question is it really surprising that such portfolios actually outperform cap-weighted indices? And well, the answer is probably something that is not really surprising. So if you go back to my kind of example of how you could construct such a portfolio, and of course in practice, in research, you don't take monkeys, you take computers to do these kinds of exercises. But so the result is actually not very surprising, because you will come up with something that on average is actually an equal weighted portfolio, right? If you randomly give weight with equal probability to each stock, and you kind of assign packets of identical size of weights to each stock, on average you're going to come up with something that is equal weighted. And if you do that many times, you have some deviations of each portfolio from the equal weighted portfolio, but these deviations are random, and on average across many such random portfolios you're going to hold an equal weighted portfolio. And so basically what you're just saying is that equal weighted indices actually outperform cap weighted indices, and that's something that has been widely known before this monkey portfolio argument has been put forth. And so this part of the argument is not very surprising. It's just kind of a perhaps interesting way or kind of funny way of explaining this effect of equal weighting. And so these monkey portfolios, they're not that random, because they're actually on average equal weighted, and what is random is the deviation from equal weighting. And so you haven't actually really provided any new insights. We know that equal weighted portfolios actually tend to outperform cap weighted portfolios. Now there's a second part of the argument where it becomes even more interesting. So the second part of the argument says that basically, well, any smart beta strategy or most popular smart beta strategies, they actually behave just like these monkey portfolios. And so in a way they are just like equal weighting. They may be random deviations from equal weighting, but they don't actually have anything that makes them fundamentally different from a simple random strategy. And of course that's kind of a very strong finding. We know that over the past 10 years, different providers have come up with different strategies. Quite often these strategies use quite sophisticated portfolio design, including kind of risk parameter estimation, including, portfolio construction methods. And so basically saying that all of these methods, they just boil down to monkey portfolios, they're as good as monkey portfolios. This, of course, is quite a strong statement. And so this is the second part of the statement. Not only do monkey portfolios outperform cat-weighted portfolios, but actually all smart beta strategies are kind of monkey-like, and in that sense, they're all quite similar. This argument has been supported empirically, and this is actually, I think, what I really like about this argument, is that you can test it in quite a straightforward way, at least some aspects of it. And so these two aspects that have been tested, and we have some citations here from proponents of this monkey portfolio argument. So the two aspects that have been tested as well, there's a first issue, which is smart beta strategies basically will automatically and always result in simple value and size tilts. Okay, and this is similar to these random portfolios or portfolios that are equal weighted on average. They effectively tend to pick up value and size tilts, and the argument is that's all that they do. And all of smart beta also only does that, and there's really nothing else than simple size and value tilts. And this is interesting because you can test it, and you can see whether effectively value and size tilts explain everything and explain all of the performance of these strategies. The second argument, which is even more surprising, and I think this is what kind of created a lot of attention on this research, is actually quite an extreme statement, saying that if you take popular smart beta strategies and you look at their performance, okay, that's fine. But now what you can do is you can invert these strategies. So you basically just take the set of weights, you invert it. You do completely the opposite in a way of the methodology. And the claim is basically that these so-called upside-down portfolios, they will also outperform cap-weighted indices, and they will actually do as good or even better than the original strategies. And this is really where clearly the argument is quite strong, and where you can see that if you state that the upside-down version, the inverse of a supposedly sensible strategy, also yields outperformance. This is kind of the ultimate proof that clearly this must be completely random, because if you do the inverse of it, it still works. So these are kind of the two kind of strong arguments which have been tested also by monkey portfolio proponents. And the final conclusion really is very important. So if effectively there's nothing but value and size tilts, and if effectively any strategy is as good as the upside down version, this has quite strong implications for investors who are interested in a smart beta, because if you look at smart beta strategies, well, basically what monkey portfolio proponents claim is that they may be based on some kind of seemingly reasonable investment philosophy or investment belief, but actually these investment beliefs don't matter. Okay, it's all just value and size, and if you do the inverse, you get kind of the same or better outperformance. So this really makes the selection of a smart beta strategy extremely easy, right? There's this whole set of smart beta strategies, they all behave in the same way. It really facilitates this selection task. There's not much due diligence that you need to do, and really there's they're all the same. There's nothing to be gained from them. They all behave like monkey strategies. So that's kind of the essence of the argument.
Okay, interesting. So essentially, monkey portfolio proponents are just saying that whatever the strategy chosen, investors will get exposure to size and value tilts and essentially still outperform a cap-weighted index. Okay, and so moving on, have you tested these claims? Are size and value tilts alone sufficient to explain outperformance?
Yeah, so we actually tested some of these claims. Maybe just before going into the actual tests, it's just interesting to think about this claim in a little more detail, and this really leads us to go back to the problems with cap-weighted indices and also the issues that smart beta strategies address. And if we look at the problems with cap-weighted indices, we can see quite clearly that they're kind of two separate issues that we can look at. So I have a slide that kind of illustrates these issues. So they're quite strong perceived shortcomings of cap-weighted indices, and they are two different types of problems that these indices have. So the first problem is really a concentration issue. And so, I mean, it's pretty intuitive if you look at any cap-weighted index. This index typically has a very high weight in relatively few, so-called large or mega cap stocks. And then even if you have a large number of stocks in a cap-weighted index, say you have hundreds of stocks, so sometimes 1,000 stocks, in terms of the effective number of stocks, you're actually holding quite a low number of stocks because the top 10 or top 50 stocks basically make up most of the weight. And so this is where some smart beta strategies have basically tried to address this concentration issue by providing better diversification. And equal weighting, for example, is a kind of a simple way of getting better diversification. You spread out the weights more equally. And so given that there is this strong concentration problem, it's perhaps not surprising that even things as simple as equal weighting, or even as simple as monkey strategies, if they're designed to be close to equal weighting, it's not surprising that they also outperform. They probably do better on this concentration issue than cap-weighted indices. A second issue with cap-weighted indices is an issue of factor tilts. Okay. So if you look at the composition of a cap-weighted index, cap-weighted indices tend to give more weight to growth stocks as opposed to value stocks, and also tend to give more weight to large cap stocks as opposed to small cap stocks. And now we know from, say, the Farm and French model from the early 90s, we know that a value tilt is rewarded, a size tilt is expected to be rewarded. And so if you use a cap-weighted index, you're actually not tilting to these factors, and you're even tilting towards stocks that have the largest size and are more growth stocks than value stocks. So these kind of shortcomings of cap-weighted indices, of course, mean that indeed there are many strategies, even quite naive or so-called heuristic strategies, that manage to outperform cap-weighted indices. And again, in that sense, the monkey portfolio argument is not that surprising. But now, if you look at these two issues that investors face with cap-weighted indices, smart beta strategies from the outset had been actually designed to deal with typically one of these issues. And so if you look at smart beta, the early smart beta strategies, a lot of the early smart beta strategies in particular are different ways of addressing this concentration problem. So we talked about equal weighting. So of course equal weighting addresses this problem of too much concentration. But you could also use a strategy like equal risk contribution, which is also a popular strategy. So it's more sophisticated than equal weighting. You're looking at balancing not just the dollar weight in each stock, but the actual risk contributions. But in the end, you're not going to be dramatically different from equal weighting. So even the kind of proponents of equal risk contribution typically show that the portfolios in the end may somewhat resemble equal weighted portfolios. And so these early strategies, we also call them Smart Beta 1.0.
Okay.
So these early strategies of Smart Beta 1.0, they typically address only one of these issues, and the most popular ones typically reweight the stocks to address this concentration issue. Now, these were strategies which we refer to as Smart Beta 1.0. So Smart Beta 1.0 is the first generation. They've been around for around 10 years now, and they really typically just provided some form of deconcentration or some form of improved diversification. And now that also leads to typically an implicit factor tilt, away from the tilts of the cap-weighted portfolio. So, some of these strategies may well pick up, a lot of size and value exposure, for example. But what I think is kind of missing in this monkey portfolio argument is actually that we've moved on. There's been lots of product development, and there's been lots of development over the past 5 years, that we've moved on to the second generation of Smart Beta. And I just have a slide here kind of illustrating this approach, what we call Smart Beta 2.0. So Smart Beta 2.0 basically recognizes that you can effectively use a better diversification method, an alternative weighting scheme, and that's going to be used in some non-cap weighted index. But you can also control the factor tilts, and you can do that in a very simple manner. You can do that with a simple stock selection. And so if, for example, I don't want these value tilts, I can, of course, have a stock selection that tilts towards growth stocks, for example, and that doesn't actually prevent me from using an alternative weighting scheme. And there's really no reason why I would expect that this kind of weighting scheme applied to growth stocks would actually lead to a value tilt. So kind of once you have this flexibility with the Smart Beta 2.0 approach, it's really not clear why you would automatically end up with these different, with these kind of mechanical exposures to size and value. So this is kind of clearly missing in the discussion of smart beta and the monkey, their link with monkey portfolios. Now, in terms of, so what are the actual tilts that we get in the different strategies? And do they boil down simply to size and value? So this is, again, where you can test this empirically. It's quite straightforward to do that. Now, the big question is, what kind of strategies do you actually test? And here, what monkey portfolio proponents have been using in their research is essentially kind of broad indices using an alternative weighting scheme in this kind of smart beta 1.0 approach. So what we actually did is we tried to figure out, well, do these claims hold more generally? You know, because if I just use equal weighting and things that are close to equal weighting, it's not very surprising that, you know, they have size and value tilts that look like those of equal weighting. So we were interested in testing a whole variety of smart beta strategies, and especially we tested strategies that you know, also use explicit factor tilting methods. So this corresponds to, you know, the now popular factor indices. And we have quite interesting results, so they're shown here on this slide. So what happens in terms of value and size exposure across different smart beta strategies? Well, we tested essentially strategies that have an explicit factor tilt. So we use a stock selection. We select, you know, 50% of the stocks that have the best value score, that have the highest momentum score, for instance. We do that across six different factors. We also do it in a multi-factor approach. And then we're going to use a weighting scheme on top of that stock selection. In the paper, we actually, you know, tested different weighting schemes. So we have a simple score-weighted method where we simply weight by the factor score. We also use diversification-based methods of actually weighting the stocks for a given factor tilt. And the results are quite interesting. So we also compare these strategies to simple equal weighting and also fundamentals-based weighting scheme. And so what you can see is that for example, the fundamentals-based strategy and also the equal-weighted strategy, it's actually true. We confirmed that they are positively exposed to the size and value factor. And, you know, they have relatively low exposures to other factors. But even if you look at equal weighting, it's not you know, a valid claim to say that the performance is entirely explained by the value and size tilt, because you can see that equal weighting actually has a negative momentum tilt. That's highly significant in our analysis. And so this negative tilt to momentum is going to actually have an impact on the performance and actually an adverse impact on the performance, because you know, momentum is a factor that carries a positive premium. So that's what you find on these kind of broad smart beta 1.0 strategies. Now, if you look to the factor tilted strategies, you find much more pronounced exposures to additional factors. So you have quite an interesting result here. If you look at you know, the table, all the factors that are to the right, so we tested exposure not just to size and value, but we included other factors, the momentum factor, which is well documented, the low risk factor, also called betting against beta or BAB factor. We also included a profitability factor, and we included an investment factor. And if you look at the exposures to these factors, well, a lot of our strategies are actually exposed, you know, positively and significantly to these additional factors. And on the other hand, if you look at size and value exposures, you can see that you know, some of the strategies actually have no exposure to size and value, sometimes negative exposure, for example, to value. Now, these results, it's just important to point that out, they're completely unsurprising. Okay, so you may think this is obvious. We designed, for example, a momentum tilted strategy, and obviously that momentum tilted strategy, you know, is not driven by value and size tilts, but by the momentum tilt. So that, you know, is completely unsurprising.
It's not random.
We're not really telling, you know, you anything new here, but it also invalidates this idea that whatever you're going to do, you're, you know, necessarily going to come up with value and size tilts. It's not that simple. And if your methodology tilts explicitly to other factors, say the momentum factor, the profitability factor, well, then this tilt is going to drive the performance, you know, much more than size and value tilts.
Okay, so essentially with Smart Beta 2.0, there's a lot more in play than just size and value. There are a range of factor tilted strategies that need to be taken into account, whether it's the likes of momentum, volatility, or even the quality factors. Okay, and you mentioned them briefly earlier, the idea of inverting these strategies. So can you tell us more about these upside down strategies and what they involve?
Yeah, so We actually replicated, this methodology of inverting strategy weights from the monkey portfolio research, and so we're using a very similar methodology. A key difference again is that our smart beta strategies that we test, most of them have an explicit factor tilt, and so actually inverting them is obviously quite different from strategies that are close to equal weighting. So again, what's going to happen when you invert an equal weighted strategy? Well, nothing's going to happen. It's still the same. And so that's obvious. But now what's going to happen if you invert strategies that are close to equal weighting? Well, again, not much is going to happen. So we were interested in taking strategies that are very different to equal weighting and where the inverse will be different from the original strategy. So we inverted our factor tilted strategies, and we inverted actually both the stock selection step and also the weighting scheme step. So if you look at our inverse for, say, the momentum tilt, where we're going to select the stocks now in the upside down version, we're going to select the stocks that have the lowest momentum score, and we're going to weight them, if you will, by the inverse of their momentum score in the simple score-based strategy and its inverse. And then we look at the results. And the results that we get, again, they're very different from kind of the usual results that would suggest that upside down and originals behave in a similar fashion. So we actually did this again. You can see here the results on the slide across the different factors. We also included the fundamentals-based strategy. And what you can see is that all of the original strategies lead to typically quite strong outperformance over the broad cap-weighted index. So I'm just highlighting here the relative returns in an annualized basis, on an annualized basis. So if you just take an example of momentum, for example, you can see that the original strategy has an outperformance of close to 2%, and actually the upside-down version actually underperforms by more than 2%. So clearly you don't get the result that the inverse behaves in the same way. Now you can explain this if you go a little deeper. We did this in the paper. You can explain this, of course, by the factor tilt. So if you tilt towards a rewarded factor, you're getting the premium of that factor. If you tilt away from that factor in the upside down strategy, you're actually exposed to the negatively to the rewarded factor. So you're actually getting underperformance. Now, it is true that some strategies may, behave monkey-like in this way of when you turn them upside down, they still give you outperformance. So we tested, for example, for the equal weighted strategy, we didn't, run the results. It's obvious, but for the fundamental weighted strategy, you can see that, for example, the original strategy has an outperformance of about 1.56%, and the inverse has an outperformance which is marginally higher at 1.67%. So again, there may be strategies where these claims are true, but they just don't apply generally across all strategies.
Okay, so aside from the fundamentally weighted strategies and of course equal weighted, your results show that for most factor tilts, smart beta strategies will outperform these upside down strategies. So that essentially refutes the monkey portfolio claim. Okay, so taking all of this into account, what are the implications for smart beta investors?
The implications are interesting to analyze. So I just, I'll just try to summarize a few key points in terms of implications. So I mentioned the implications of the monkey portfolio argument are, of course, extremely strong. So if you look at the monkey portfolio argument, there is something that seems actually quite negative, because you're saying, well, whatever kind of sophisticated strategy you have, in the end, it's not that relevant, right? You're just getting value and size tilts, and you may just get the same result with the opposite approach. But this original argument also has a kind of very positive aspect to it, which is basically that you shouldn't be too worried about risk. Okay, for example, imagine making specification errors on a strategy. Well, if it's all whatever you do, even if it's random, it's going to lead to value and size, then you shouldn't be too worried about that perhaps the provider has gotten the strategy wrong, because whatever he does, it's going to work. And so kind of the first implication of the fact that smart beta is not actually just similar to monkey portfolios is that, well, it's actually not that risk-free, if you will. So you have to carefully look at a methodology, because outperformance is definitely not automatic. Okay, outperformance may result from the diversification method that providers use. It may result from the kind of factor tilt that you have chosen. So you actually need to closely look and make sure that these methodologies and these factor tilts are the ones that you would expect to lead to outperformance. So there's a first message, I think, which is important. It's basically that it's not that mechanical, it's not that automatic. And so there are risks, of course, and that includes the risks of designing the strategy wrongly, and so we should be concerned about these risks. The second implication, which is quite related, is obviously what happens in terms of assessing these strategies. So if you believe in the monkey portfolio argument, this is fantastic. You don't need to do any due diligence. Anything is going to basically work, and it's all the same. So that makes the task of selecting strategies quite easy. Now, if that's not the case, and we've shown that this is not generally the case, well, you would have to think about selecting the factor tilts. That's an important question. And you need to do due diligence on what are your investment beliefs, which factors do you think will be rewarded, and there's also questions to ask along these lines. What is also for a given factor the diversification method? So smart beta can add value not just by tilting towards a factor, but creating a well-diversified portfolio along whatever factor that you tilt to is another important task, and there'll be differences across different approaches. And finally, even if you've analyzed these two issues, there's a third kind of source of value added of a smart beta strategy, which is you can potentially combine different factor tilts and come up with an allocation to different types of factors. That can be static, it can be more dynamic, and this is another important question. So the strong implications is actually that there are kind of different sources of outperformance and lots of questions for proper due diligence on smart beta strategies.
Okay, great. So in summary, these arguments put forward by monkey portfolio proponents are a bit too simplistic. When it comes to index design, there are a lot more. There are a lot more aspects that need to be taken into account in searching for an optimal strategy. Okay, great. Well, that concludes the first part of the webinar. We're now going to look at the survey results before taking some questions from our viewers online. So let's see what survey results we have. Let's see, it's just coming up here on the tablet. So on the first question, we asked viewers which one of the following factors carry a positive long-term premium. And so we see that 15% of our viewers said that the size factor carried it, 24% went for the value factor, 22% for the momentum factor, 18% for the low risk factor, and 22% for the profitability factor and other quality related factors. So that shows that our viewers and investors are aware of the various factors. What insights do you draw from that, Felix?
Yes, I think this just I think suggests that participants are well aware of the fact that there's a whole range of factors. We didn't get a result that everyone thinks that only size and value matter, and so viewers would be kind of not in line with the monkey portfolio arguments and be kind of much more aware actually of additional factors that matter. And I think that kind of reflects that what I mentioned, that I think over the past 5 years, the debate has really moved on, and we can see that actually, professionals are quite aware actually of the fact that there's a range of factors, and this whole monkey portfolio argument seems to really ignore this reality.
Okay, and the second question that we had was, just looking at it here, do you consider smart beta providers offer easy access to the following information? And the options we had there were detailed performance and attribution of their strategies, and 28% of viewers said opted for that choice. For detailed risk analytics of their strategies, 28% again opted for that choice. And for full transparency on historical holdings data of their strategies, 44% said that index smart beta providers offered access. So that again is also a varied result. What can you draw from that?
Yeah, I think what's interesting is actually that you can see that the item that receives the highest share of responses is actually relatively simple access to historical constituents. And there seem to be some shortcomings with respect to how actually transparent some of these offerings are, and how much access providers actually offer to things like the basic holdings data across indices. And I think this is, again, this ties back to the monkey portfolio argument. So, you can have, certain misconceptions that arise, especially if access to data is not widely shared. It'll be much easier to actually test and, if you will, question certain conceptions and misconceptions if actually access to data is widely available.
Yeah, increased transparency. Okay, great. Okay, now we'll move on to the questions that have been sent through by our viewers online. So just looking here, the first question we have through is the following. Can you explain how your upside-down strategies differ from the ones used in portfolio research?
Okay, so yeah, I mean, the way we constructed the upside-down strategies, we really try to follow the same methodology as what is used in the monkey portfolio research and the papers underlying these kinds of claims. And so we followed the same approach. There's actually two different ways in which this is done in the original papers. In our paper, we also tested these two ways. The key difference is that since we're looking at strategies which are based on this two-step methodology, using a weighting scheme, and then along with a factor tilt, which is done through the stock selection, we are not only inverting the weights, but we're also inverting the stock selection, which only makes sense. I mean, the inverse of a strategy that selects momentum stocks and weights them by whatever methodology that you wish to choose should obviously also invert that stock selection step. And so we actually invert these two steps in our study. And that's, if you will, not so much a difference of how we invert the strategy. The key difference is actually what are the strategies that we choose. I don't think that you could reasonably invert a momentum strategy, say, without choosing the kind of opposite stocks.
Of course.
But clearly, our analysis is quite different because we do consider these explicit factor tilted strategies. And again, the papers that basically originally made these monkey portfolio claims don't actually consider these kind of explicitly factor tilted strategies. So that also explains the difference in results that we get.
Interesting. Okay, the next question we have here is the following. To what extent, it's about rebalancing, to what extent is smart beta performance simply driven by the rebalancing effect? So can you offer any insight to that?
Yes, so the rebalancing effect is actually quite related to this monkey portfolio argument. So actually, you will find the claim that the fact that the upside-down strategy is just like the original, and also that everything ends up with value and size tilts, is kind of explained by an underlying effect, which is a rebalancing effect. So kind of whatever you do that is different from cap weighting, you're going to capture this rebalancing effect. Well, obviously cap weighting is approximately buy and hold. If you weight by any alternative means, you may actually, you have to rebalance the portfolio, you have to adjust the weights. They're not just going to be buy and hold. And so, of course, rebalancing is part of all of these strategies. But the argument has really been made that it doesn't really matter how you rebalance, what kind of stocks you rebalance, whatever you do, this is going to lead to outperformance. So this is quite related to the question of monkey portfolios. Now, there's a difference between this rebalancing effect claim and the claims about size and value tilts and upside-down strategies. And the difference is simply that this claim that there is a rebalancing effect, it hasn't been tested empirically in the same way as these other claims have. So while we were able to kind of apply similar tests about factor exposures and upside-down strategies to a different set of strategies in our empirical study, since the original monkey portfolio research doesn't actually show empirical results for this rebalancing effect, it kind of simply there's kind of discussion and explanation that it should be there, but there's no empirical evidence, if you will. We also weren't able to, strictly speaking, test a similar approach or do similar tests on our strategies. So that's why we didn't test it, empirically in the same way. But there are nevertheless a few things you can say about this rebalancing effect. So there is a discussion on rebalancing effects in the literature. But this is quite a complex topic, so it's not as simple as saying that, as soon as you rebalance, it doesn't matter how you do it, you're going to get outperformance. And there's also, little evidence suggesting that these smart beta strategies effectively are driven by the rebalancing effect. So, we could get into a lengthy discussion, but just to give you kind of two elements here. Think about our upside-down strategies, right? We saw that they underperformed. They also all rebalance, right? So because we're going to do the inverse of the original strategy, they clearly not buy and hold. And we've seen that they underperform. So you can have a strategy that rebalances, but if that does that towards the wrong factor tilts, then it's actually going to generate underperformance, not outperformance. So it's not as simple as you're just going to rebalance and that's going to create value. A second issue that you can consider is, well, how about the momentum factor? So the momentum factor is one of the most well-documented factors. What do you do with the momentum factor? You're basically going to increase your weight in the past kind of short-term winners. So by kind of many definitions of rebalancing, this is kind of the opposite of rebalancing, right? So the idea behind rebalancing is that you're going to move away from the stocks that have gone up in value. You're going to move to the ones that have lost value. Well, momentum does the opposite, and we know that very consistently across many data sets, momentum actually generates performance. So this is already inconsistent with the idea that necessarily you will get value out of rebalancing. So you could potentially design strategies that exploit a rebalancing effect and that generate performance through that, but it's not as simple as saying that automatically you will get a positive rebalancing effect, and smart beta strategies are necessarily related to that. That's not, hasn't been shown at all.
Okay, great. We have time for one more question. This one has just come in, and it says, do you see any value in the idea that strong growth in assets under management for smart beta strategies could impact future returns and results?
Okay, so yeah, this is a very relevant question. So the idea, of course, is that if lots of investors tilt towards the same strategies, then effectively you may have an impact on the price of the stocks that correspond to the right factor tilts, and if lots of money flows into that same strategy, then in a way the premia should disappear. Now this argument is, to the best of my knowledge, there isn't any kind of clear empirical evidence that that should be the case. Conceptually speaking, you should think of what these factor tilts mean. Why are they rewarded? So are they rewarded because they're kind of a free lunch and you can just tilt towards these factors, there's no risk and you still get the outperformance? Well, if that's the case, eventually it would tend to disappear unless there's some kind of barriers of why people can't exploit that. But more importantly, if these things are risky, so if factors are just a reward for taking on additional types of risk, there's really no strong reason why they should disappear. I mean, you can compare this to, say, the credit premium, right? So, people are quite aware that over long time periods, tilting towards more credit risky securities will come with higher returns, but it doesn't mean that everyone is going to do it at a large scale, because there is this risk that is involved with it. Now, going back to the monkey portfolio argument, if you think about crowding, so an important consideration is also, do smart beta investors all invest in the same factors, or do they invest in different factors? And you would think that if there's any crowding, well, it should be stronger if everyone invests in the same small set of factors. So in that sense, there's also an argument saying that, well, if this monkey portfolio claim is true and everything is just about value and size, then clearly all of smart beta will tilt to value and size stocks, and so any crowding issue will be kind of heightened by the fact that it's just two factors and everyone tries to tilt towards these two factors. We've shown that there's lots of other factors, and additionally, if investors do not all tilt to value and size, but they actually tilt to a whole range of factors, 6 factors or 5 factors or similar number, then any kind of crowding concern should also be less than if there's a small number of factors.
Okay, great. Well, that brings us to the conclusion of today's webinar. That's all the time we have for today. Thank you, Felix, for sharing those insights. We hope our viewers have found this informative. If we were not able to answer your questions now, we will be sure to respond to you by email. If you do have any further questions, please do send them to us at webinar@scientificbeta.com. We've also published a recent article on this topic called Smart Beta is Not Monkey Business, which features in the current spring issue of the Journal of Index Investing. It's available on our website, www.scientificbeta.com, and we will send you the direct link to access it, along with a link to replay this webinar, and you can download the slides you saw in the presentation. And lastly, if you don't do so already, please follow us on social media. We're on LinkedIn, and our Twitter handle is @scientificbeta. So that concludes today's presentation. Thank you very much, and goodbye.